Hey guys, Pure Billionaire here. Today we're going to talk about the war for your money between stocks and equities, bullion, and CDs, treasury bills, your savings accounts, and bonds. So, big day today because the Dow Jones dropped over 500 points. Silver and gold are up about 2% over the past 1 week. And the 10-year Treasury T-bill is almost at a 5-year high, and today it's hit 4.77%. So, was there news that kind of triggered these movements today? Well, apparently the December jobs report is incredible, and there's over twice the amount of jobs in America that we expected. But talking to people, if you're an average American, if you have been reading online, nothing's getting more affordable. And in fact, there's a lot of full-time jobs that aren't even allowing people to live off of that job alone. So there's actually a fair amount of people now that are working multiple part-time jobs. Okay, you probably know people like this. Maybe you're one of those people yourself. That, of course, will falsely inflate the jobs report, and maybe in February or March, in a month or two, we will see a correction on that, and that just may have another effect on the markets. But the real war that's happening on here between moving money is that people want to get the highest rate of return for their hard-working dollar. So with the 10-year T-bill up to 4.77% now, almost at 5%, wouldn't you want to put your money in a high-yield savings account, bond, or CD, or the 10-year Treasury bill investment where you can get some guaranteed nearly 5% yield? Why risk your money in stocks or in equities, right? Well, you have to consider that when these interest rates are high, yes, your bonds, you're getting more money in an annual yield, but don't forget that your auto loans are going to stay high, your home loans are going to stay high, your student loans are going to stay high. It's going to be harder for new businesses to open because the interest rate loans are going to be higher for them as well too. So there's this constant movement, this ocean back and forth of high and low interest rates. Now, don't forget, the Federal Reserve is meeting, I believe, January 29th to say that they're not going to lower interest rates anymore. I believe there's a 95% chance that that will not happen. And in March, the interest rates are probably going to stay the same as well. There's at least a 70%, according to the Federal Reserve's website, that we're going to hang where we're at for a little while, so to speak. So people are thinking, I'm not going to risk my money in stocks and equities. Let's move to the T-bill. But where does bullion come into this? Well, with higher interest rates, it really represents some economic restriction, because think about the business loan. Why would you take a loan out for a business or whatever business-related expenses that you have at such a high interest rate? So in the future, this is going to not look so good for the jobs reports, inflation, etc. So if inflation might tick up in the future, which we really know that it's going to, people are moving towards bullion, silver, and gold. Now, my theory was that especially with the holidays, people are broke. They're just starting to get their paychecks now from working the past couple weeks. And people who are able to, they're starting to re-up their normal investing again. Maybe some people took a break recently. But typically the T-bill and the bullion prices are working inverse, but today they happen to be parallel. Together, they're inverse against the United States stock market. So we'll see where things head, but I'm wondering, are you moving money out of the stock market, or are you buying the dip? Okay? Are you using some of the profits from bullion in order to buy the dip of the equities? Or are you selling bullion, selling your stocks, and heading into the 10-year Treasury bill that's almost at a 5% interest rate? Well, let me know your thoughts. We'll see what the future news holds for us. Have a great weekend, everybody.